So in general, because we've been in a strong dollar environment for the past 10 years, there's not been a lot of net reserve accumulation, even though there still has been money supply growth, broad money supply growth. On average, the level of reserves has been decreasing relative to M2 for a lot of countries because most of them are more in currency defense mode than reserve accumulation mode. Now, if we get a big dollar down cycle, you could see a big multi-year period of reserve accumulation, but that's not the environment we've been in. And so, yeah, a lot of them are going down in terms of reserves compared to broad money supply.
Did you know that over the past decade, the strong dollar has led to a significant decrease in net reserve accumulation, despite continuous money supply growth? If we enter a big dollar down cycle, we could face a multi-year period of intense reserve accumulation, dramatically impacting the global economy. This could mean a severe crisis for the US economy, with potential ramifications for your investments and savings. Lyn Alden highlights that developed countries, particularly the US, have been in a currency defense mode rather than accumulating reserves. This trend has led to a decrease in reserves compared to broad money supply, leaving the economy vulnerable. Imagine the consequences of a significant economic shift, where the US might have to sell treasuries and buy gold, a move that could send political shockwaves globally. Countries like Russia, China, and Turkey are already strategically increasing their gold reserves, preparing for such scenarios. As the dollar weakens, these dynamics could trigger a cascade of financial instability, inflation, and devaluation of currency, affecting every aspect of our financial lives.
There's a couple ways to look at it. You can look at it as a percentage of their GDP. You can look at it as a percentage of their broad money supply. You can look at it as a percentage of their external debt. So, for example, if a country in aggregate has, $100 billion worth of external debt to either its sovereign or its corporation denominated in currencies they can't print, you might want to then compare their reserves to see, how if they had to, how much of their reserves would they have to sell to cover most of their debts. So that's another metric to look at. So it depends on what exactly they want to do with their reserves. Those are all useful metrics to be familiar with, because a less indebted country might need fewer reserves. Also, in general, developed countries tend to have less reserves relative to their GDP than emerging markets, because developed countries tend to have most or all of their liabilities financed in their own currency, and so they're less likely to kind of need to support their own banks with foreign currency, for example, compared to emerging markets where that's a bigger deal. So reserve practices will vary, and it's not always like that higher is better. I mean, basically, if a country is having a current account surplus and a trade surplus and its currency strengthening, that would otherwise go toward wage earners in that country. That would go toward savers of those currencies in those countries. And instead, when a country is accumulating reserves, it's making sure that its currency is not getting stronger, which actually takes away from the wage earners. It takes away from the savers. But of course, down the line, they could use it to defend the currency should it weaken. But in general, a country that's always accumulating reserves is generally running a rather mercantilist policy, which is that it's trying to keep its wages and its kind of citizenry not super wealthy, so that they remain very kind of competitive on the global scale in terms of labor costs. And instead, a lot of that capital's flowing up to the top, the policymakers, who then have more control over it, rather than kind of letting that flow into the country in a more decentralized way, and kind of flow more toward those individual entities. So I think partially because they're closer to the center of the current system, and so they have less incentive to change the current system. Many cases, they're not increasing their reserves at all because, again, most Western countries, their liabilities are denominated in their own currencies. So most European entities, their liabilities are in euro. North American companies, their liabilities are denominated in dollars. Same thing for Australia. Same thing, Japan's not exactly in the West, but it's kind of Western aligned. Same thing's true for them. Most of their liabilities are in yen. If anything, yen is actually the third biggest foreign currency financier after the dollar and the euro. And so they just have general less need of reserves, period. And then, Europe, for example, and the United States, they already have a lot of those countries already have fairly large gold reserves as a percentage of their reserves. And so we just don't really see a lot of, reserve accumulation. A lot of them are not running big current account surpluses that would lead them to have a lot of ammo to accumulate reserves. And so a lot of that reserve accumulation would probably have to come out of other holdings. They'd have to like sell treasuries and buy gold, which is somewhat of a political message. And so, yeah, there's kind of not been a lot. The incentives don't really align currently for a Western country to kind of step out of the pack and just start rapidly accumulating reserves, let alone gold reserves specifically. So because it risks inflation and devaluing the currency, basically. You mentioned, for example, an unstable currency. If they already have an unstable currency, then they're in a difficult position of accumulating reserves because they ironically might have to make their currency even less stable while they're accumulating reserves. If they're printing a lot of their currency to buy gold, it means more of the supply of their currency is hitting the market. And so, if they're already dealing with double-digit CPI, for example, and there's popular unrest because of that, civil unrest, last thing they want to do is maybe add another 10% to currency supply and increase their gold by a lot. So some of them do it despite high inflation. They might do it in fairly small amounts. So they're saying, look, we got to think longer term. I know inflation's high, but we still want to increase our gold reserves. They might do it anyway. But in general, reserve accumulation tends to happen more from a position of strength. A country's running a big trade surplus, current account surplus, their currency's holding up well compared to the dollar. And then they say, look, now we're going to use this opportunity to keep our currency from strengthening. So we don't make our labor too expensive as far as they see it. And we're going to use that context to accumulate reserves. Whereas usually when they have currency instability, if anything, they might be selling reserves, or they might be trying to hold reserves steady because they're trying to reduce the instability of their currency in the moment. It's hard to think 10 years in the future when you're worried about, the public unrest about inflation this year. Well, so if you do it very rapidly, the race is on. I mean, your currency is going to start collapsing, and you're going to get your reserves. You're probably not going to make friends in the international community, like the IMF. So there's kind of a sort of a hierarchy there, or there's a club there. And if countries find themselves kind of out of the club, things are going to be rougher and different for them going forward. And so there are kind of certain international frameworks. Also, countries can be labeled as part of this club. They can be labeled currency manipulators. If a country is purposely keeping its currency very cheap and is rapidly accumulating reserves to keep its currency cheap, the United States or other countries might call them out. And then that could have political implications. It could have IMF implications, things like that. So there are kind of these dissuading methods to kind of represent, diminish these more outlier type of activities, at least as a large percentage of their GDP or large percentage of their M2 from happening kind of at a quick basis. There are people that are more tapped into the plumbing of the gold system than me, but in general, a lot of these really large buyers, like sovereign buyers, a lot of them are going to do over the OTC purchases. So you're not going to a defined exchange. They're making a more kind of peer-to-peer private agreement to accumulate it. For many of these countries, they'll buy it from their internal producers. So, for example, Russia, China, Turkey, they have decent gold production. So you'll generally see purchases from them. They also can buy from international producers. They can buy from international large refiners that are capable of kind of brokering pretty big contracts for these things. And then, there also are exchanges, for example, London notably, where fairly large amounts of gold could be purchased. So it really kind of depends on whether they have internal production and what size they're buying in. But a lot of that's going to be off exchanges.